My topic is Thymology. Okay. Some of you have read through, probably in particular, the works of Mises, may have been exposed to that term, in passing. Certainly, those of you who've read, Theory and History are familiar with the term Thymology. In fact, I think there's 2 copies still downstairs. So what is Thymology? Well, I'll eventually address that issue. And how does it relate to fundamental analysis? And fundamental analysis of what? This talk specifically addresses security analysis. Okay, how we go through the process of selecting stocks, bonds, what have you. Okay, so that's where we're going. And I've been teaching finance and investment courses for about 14, 15 years now. And worked in the industry for 5. Okay, Merrill Lynch, and as a private money manager. And and through it all, I thought it was interesting as I went from practitioner to PhD program. The divergence in views and, the way the theory was derived and presented. And quite honestly, I'm lucky I got my PhD. I just happened to find one guy in the department that shared some of my views, and he sort of carried me through because I was just too antagonistic to a lot of my professors, as I went through their classes. Okay, because here's the ex-money manager, broker, whatever, with his comments about that doesn't work, this doesn't work. What do you mean market efficiency, whatever. Okay, so those are some of the things. But as a professor these days, trying to address the subject to my students, I said, how do I teach this stuff? So one thing that really matters to me, more than anything, is just really trying to get to the crux, to the truth. Okay. And giving, a student something valuable, something they could take with them, something that works. Okay, not rehashing a book, models, theories, and things that I knew as a practitioner basically didn't work. Okay, so this got me to thinking as time went on. I was very fortunate to, by luck, if you will, maybe Providence, get a job at Grove City College. And that's where I was introduced to the works of Mises and Rothbard. And that's when a light bulb went on. Okay, and this happened about 1999, actually. All right. So let me start first by just sort of giving a little background on fundamental analysis. Okay. Fundamental analysis basically, all right, looks at, publicly available information, okay, quarterly reports, annual reports of corporations. You look at suppliers, vendors, you look at the whole situation, surrounding a firm, and you basically try to take that information and make sense of it. Okay, and translate that into some type of a estimate of stock price, okay, an appraisal, if you will. All right, I know the word valuation is used a lot, but valuation sometimes means something different than appraisal. So you're trying to appraise the stock price. And fundamental analysis, kind of got its big start with Benjamin Grimm and David Dodd's Security Analysis, published in 1934. They, of course, are especially Benjamin Grimm was the teacher of Warren Buffett. So I know everybody here knows who Warren Buffett is, I believe. All right. In fact, as a note on Buffett, he did release his note to shareholders a few weeks ago on February 28th, and that's a good read. Everybody here should go to BerkshireHathaway.com and take a look at Buffett's latest assessment of things. It's very interesting. But in any event, Buffett, of course, is one of the most successful. Still, in spite of the recent downturn, at least as of 2008, he was still ranked number 2 in the world in terms of richest folks alive. So, second to Bill Gates. All right, so has a pretty good track record. All right, well, once again, my topic is trying to look at Austrian economics and tie it together, with some form of security selection. Okay, in particular, I'm homing in on fundamental analysis. All right, and there's been other work done here. Okay, Passor presented a paper on market efficiency and the effects of entrepreneurship. Shostak on fundamental analysis in business cycles, and there was also a short paper by Kaza on fundamental analysis as a form of arbitrage. In spite of the papers that had been written in the past, nothing really forms a theoretical base for fundamental analysis. Okay, so that was my quest. And it still is. This is a work in process. All right? So this study strengthens the case for fundamental security analysis, a form of security selection compatible with an Austrian economic view. All right? So that's where I'm going. And, we have to look at other methods. Right? So I do a quick critique of competing methods of security selection in terms of their consistency with an Austrian view. Okay, I got to watch because I'm saying Austrian economics, but to be quite frank, when I'm talking Thymology, I'm not talking necessarily economics. I'm talking about another branch of science according to Mises. Okay, so, but we will use sort of a praxeological approach to assessing the other forms. Okay, and it evaluates issues relative to fundamental analysis as a primary means for security selection. So, if we look at it, I'm going to just take a fast look at technical analysis. Okay, now technical analysis basically means that those who look for patterns, look at charts and price volume, use oscillators or use anything else that academics can't describe actually. All right, but we'll look at technical analysis, quantitative analysis. Okay, which basically is model based. Sort of outgrowth of quantitative analysis is this idea of passive investing. I kind of gave it its own category because it's become sort of a popular fad over the last few years. That just put your money in a couple of indexes and just let it ride. Okay, folks have done that lately, haven't fared so well. And of course, fundamental analysis. Okay, and fundamental analysis, sort of boils down to stock picking. Picking stocks for investment. So let's look at technical analysis first, okay? And once again, what you're looking for as a technician, in many cases, is some kind of a pattern, okay? And as human beings, we all tend to look for patterns, okay? So I think it's just a matter of the way our brains have kind of evolved. So when you're out in the jungle, you can recognize what type of pattern of leaf is edible versus which ones will poison you or make you itchy, or which animal is food, which is which animal pattern. The tiger coming at you will eat you. So we haven't necessarily had to use patterns, okay, to give us information about what we can anticipate happening. And we do basically the same thing with technical analysis. Okay, so you're looking for these patterns, okay, to help you foretell the future. Okay, now one of my problems with this is that there's this presumption of causality. Okay, where there's these repeatable cause-effect relationships that the technician has to automatically incorporate. Okay, so when you're looking at some type of a head and shoulder pattern or something like that, that dictates to you that, okay, although the market is going to go down from this point forward, no real rhyme or reason for it other than there's the pattern and something's going to follow, okay? And of course, techniques like that really are sort of black box bother me. I have a lot of trouble with things where there's no, theory behind it. There's no foundation behind it. Okay? Because when you're using techniques like that, then you can easily, especially in financial markets, succumb to the problem of randomness, you see. Okay? Because anybody who's invested in the stock market knows it's very difficult to project which way things are going, and there's a lot of things that happen you just can't anticipate or expect. There's random things that happen. Okay, all right. So one of the problems you have with technical analysis, of course, is that you may think you're doing something purposeful, okay, and you may be right just as a matter of luck. Okay. And I've read several books by technicians, Pring and others, will essentially tell you, well, this stuff, you got to be careful with it, it's something to use in addition to other techniques of security selection and so forth and so on. All right? So there's always some kind of a qualifier there, and this may not work. All right? So, and we get back to Mises, Mises, clearly states that purposeful human actions are not causal, but they're teleological in nature. Okay, so you have to go back and study the situation, all these factors that are affecting it to make sense of it. You just don't have these cause-effect types of relationships like you do in chemical reactions and whatnot. Okay, so human-based events are unique, non-replicable, and are of limited value in anticipated human transactions. Okay, to be quite frank, I still have looking for some input, because I know a lot of Austrians tend to embrace technical analysis for some reason. So if somebody can shoot me email or something like that and tell me why they think that I'm wrong, I'd like to hear those alternative views. But I thought about this time and time again. I just can't justify it. All right, quantitative analysis. This is easy to knock out. Okay, this is really easy to knock out. Okay, now what is it? Mathematical modeling and econometric applications to identify investment opportunities. Okay, so you let your computer do the work for you once you've done the work of programming it. All right. Now I'll just point to one author. Okay, there's many studies on it. This isn't something Talib here, 2005. This is a reference to his Fooled by Randomness book, right? Okay, but you can go back to financial texts decades ago, where you get this full-blown presentation of how to develop the CAPM as an estimate of cost of equity. Okay, and then you always love this. You get to the end as well. There's major problems with this, though. After you spend a whole semester or something like that studying the thing and learning it, and you're all excited that we can take this model and get something out of it. And then there's all these disclaimers at the end. And you sit there and say, wow, wait, I wasted my time on this. All right. Well, in any event, okay, he does I think was one of the first people really to come out and really articulate the problem with return distributions. Okay. And there's all kinds of ways that the folks in finance try to get around this. Well, what about the central limit theorem? And what about this, and other thing? Well, we can assume, it's okay, it's close enough and everything, but no. Here, we do have human beings that constitute participants of financial markets. I know there's computer trading that goes on where you don't have non-human trigger points and stuff, but for the most part, we got human beings there. Return distributions are not normally distributed. Okay, this being the core assumption of quantitative models. So as I look at any one of those things, okay, and why do I say that? Because I know very few models out there that can use fractal geometry, or they can use chaos theory or some other method that uses different types of distributions. So this thing's right at the core. All right, and in fact, we don't know what the return generating process is for securities returns. Now that's not new news. All right, this topic has been brought up repeatedly, or it's implied at least. If you sit there and you read things by Mises, Hayek, Hassor, Shostak, Rothbard, that they all point to that same problem. Okay, you can fish it out of there in every single instance. Okay? But in spite of this, okay, the Achilles heel, if you will, academics and practitioners are promoting ever more sophisticated financial models and means to manage risks, generate returns, and form mechanical solutions to financial problems. Okay, so it's at a point, there's a little quip by Warren Buffett in his latest shareholder letter where he said, hey, along the lines of if this was the case, then, librarians would be running corporations. Okay, I would say, well, maybe statisticians would be running corporations, right? You think about it, you just model it and put your data into it and grind out your output, What do you need someone to exercise subjective judgment for? Okay, expertise. Passive investing, current fad or emphasis in investing. Here you go. Following the tech boom crash, right? You have folks that say, oh, well, what you need to do is just diversify globally. All right, if you do that, you have a good diversified asset allocation, and you indeed look at your own risk tolerance level as if anybody could tell me what it is. Okay, I still haven't figured out a way to measure my own risk tolerance level. All right, so I don't know what that is. I guess some folks say if you could sleep at night, you versus not, you'd hit it. I don't know. All right, so but what is that? So that's the current fad, but you allocate according to what you can sleep with, I guess. Outgrowth of academic work that prescribes quantitative approaches based on the assumption of market efficiency. So this is your efficient market hypothesis, right? Okay. EMH states that if market prices quickly and accurately reflect known information, the price is right. And only unanticipated information can impact prices. As Austrians, we would say that the price is right, but we might argue as to what the price is and what goes into the formation of the price and what might happen in the future. Okay, to the folks at maybe the University of Chicago, where this kind of thinking originated, this has more to do with information arrival, the rational human being being able to anticipate information and not anticipate some things that just sort of come out of the air, both good and bad. And because we can't guess all that stuff, then the price just sort of follows its own little stochastic process or some random walk or martingale or whatever you want to call it. All right, depending on your level of familiarity with stochastic calculus. All right. Well, the outgrowth of passive investing is modern portfolio theory. Okay, so your passive investors use the MPT. Okay, if said real fast and loud, comes up empty. But nevertheless, what's this about? Portfolio risk can be substantially reduced through diversification. Don't put all your eggs in one basket. That sounds like sound advice. But Harry Markowitz, back in the 1950s, 1952, tried to quantify this. All right? And, what Markowitz's prescription was, what MPT does, is it says that you should invest in securities or different asset classes based on a different view of risk and reward. Based on a view that you look at the cross correlations between securities, and once again, you diversify away some of the idiosyncratic risks, and you got the risk there left over that you're paid to take, your systemic risks. You use a quadratic program to find your security weights, okay? And, if you want to, you could pick securities, but and throw them into the optimizer, as you will. But most of these folks just sit there and take a couple exchange traded funds, indexes, or something like that, and plug them into the optimizer and come up with their allocation. Okay, there are a lot of implications, a lot of problems with MPT. All right, now Passor, our Austrian, in '89, basically states that MPT totally ignores the role of the entrepreneur as one whose emergence disturbs the mix, resulting in new opportunities for profitable investments. I translate that this way. The implication is if new opportunities arise that change the risk-reward characteristics of the investment portfolio, then correlations between securities are not stable, and an optimized portfolio will not achieve desired outcomes. Okay, so amongst some folks that use these things in practice, and others that critique them, they call them error maximizers. Okay, because what they do, they tend to you tend to overweight in securities that are, for lack of a better description, overpriced, and underweight in those that may present good investment opportunities or be underpriced. Okay, so lots of problems with MPT. There's a little tag on that too. NPT has found its way into many aspects of the way our monies are managed these days. Okay, you have your prudent investor rule that basically mandates now that you have to use a modern portfolio theory, okay, to manage your assets. Okay, if you're a fiduciary, you're running a pension fund or something, and the Pension Protection Act of 2006, in relation to 401k plans, 403b plans, states that you have two choices if you're advising on a 401k plan. You either use a optimizer or you use someone who has a certified financial planning credential as a fiduciary, okay, to give advice, and they can't take any commissions. They have to work on a fee base. All right, but this NPT has gotten in there. It's very influential now. Yeah, under NPT, okay, right? Yeah, a lot of folks will have to rebalance their portfolios. Okay, mandate. Okay, and sometimes the NPT will go hand in hand with some type of a strategic asset allocation. And what you have right now is a problem where stocks have fallen down so much in relationship to bonds that these guys are basically going to be forced to rebalance and buy stocks to bring the stock portion up, according to the stated objectives of the client. And when you see little rallies that seem like they come out of nowhere, it could be NPT rebalancing rally is what you're seeing, All right, it's very probable. Okay, it shouldn't happen in an efficient market, but once again, all right. So fundamental analysis. Okay, let's get to the crux of this quickly, so we have some time for question afterwards for everybody. All right, this paper argues that thymology, awkward word, albeit, is the field of science, the philosophy, if you will, that underlies fundamental security analysis. And it's proposed by Ludwig von Mises, not me, right, in Theory and History, 1957. 2 copies downstairs. Okay, similar to the method of study used by historians and those involved in natural psychology. Okay, now he goes through a lot of efforts. You could read through Theory and History. I recommend everyone. That's a great book. Okay, and to sort of sit there and give you the difference between someone who does psychiatry or does some type of other type of psychological studies versus the psychology we're talking about, which is psychology of human emotions, motivations, ideas, judgments, values. Okay, so he goes and uses it. It's clear to air what's called thymology. Okay, get the psychology stuff out of it. All right. And my claim is that thymology is basically the philosophy behind fundamental analysis. Okay, knowledge of human valuations and volitions is basically the crux of thymology. All right, volitions, it's free will to make choices. It's basically a study of choice. It's a study of why we choose one object over another. The motives involved. The importance of security analysis is used to understand why others may engage in future courses of action. All right, when it comes down to any type of entrepreneurial activity, okay, whether it's security analysis or trying to pick stocks, if you will, or trying to decide whether to put a grocery store at the end of the street, is phenomenological. All right, it's an offshoot of introspection. I'm human, so I know. To some extent, the way you may feel about something, right? So you sit there and you sort of superimpose, the way other people may act or whatever by sort of building a mental model in your own head of what you would do in a certain situation given certain environmental stimuli or whatever. I don't know. Okay, and a perception of historical experience. So it's what, to quote Mises, is what everybody learns from interactions with his fellows. It's what a man knows about the way in which people value different conditions, about their wishes and desires, and their plans to realize these wishes and desires. Okay? So, I'm always reading this stuff with, once again, a finance overlay. How does this apply to my area? How does it apply to my area when I'm reading through these things and picking up these things by Mises? Right? So it begins with a study of historical data and events. You study the past first. Okay? You use what you learned there. There you acquire your knowledge about the past, right? But that's not the ending point. And more specifically, identify key factors that influence certain past events. Okay? So as you're kind of honing in, it's a learning experience. That's all it is. Current information, number 3, current information, recent historical events, is interjected into the analysis and then synthesized to form mental scenarios to evaluate future courses of action. All right? So this is a process of putting it all together in your head. It's the primary tool of the entrepreneur. Okay? So, entrepreneur, every time you're doing something, you do something new. Right? You look at something that no one else does. So, I know franchise or something. But still, even at that, you have to sit there and evaluate the situation at hand. You want to put your franchise there, right? Okay, so it's a primary tool engineer. It's a process that's based on the way we're wired. Okay, based on how the human mind processes complex information and arrive at conclusions about future actions. So this is what we're born with. Okay, we're not born with optimizers in our heads. We have this ability. All right. Fundamental analysis, and those who follow it, are basically engaged in a thymological process. And this is where I got thinking about this because, I watch my students. I have them do these security analysis projects, right? And what I started to see is by going through the process of doing a fundamental analysis, they learned the industry, they learned how the economy affected that particular company and its stock, and lo and behold, they are able to make projections that were pretty good, okay, in terms of guessing which direction the stock was going to go in terms of its increase or decrease in price. You never get the point estimates of stock prices exactly right, but they could get the directions right, and they were pretty good at assessing whether a stock was over or undervalued, or fairly valued for that matter, okay? So, and what do, right? So the initial task of the fundamental security analysis is to gain understanding of the firm, its industry, and the general economic and political environment in which it operates. One real, advantage you have here is if you're approaching your economic analysis from the proper perspective, an Austrian perspective, that gives you a big leg up. You understand business cycles, right? Okay, you understand what generates them. Okay, so that's a fundamental advantage. Assessment of historical data by studying economic conditions, the industry, corporate reports, news release, all that stuff that's out there, right? And you kind of put together into what you think is going to drive the value of that particular stock, if you will, at this point in time and in the near future. All right. Once the investor has confidence and level of understanding, he then synthesizes this information in a coherent structure used to forecast and evaluate securities and investment merit. He used the Gedanken, right? Okay, the mental experiment is what you use. All right, so you're playing through these scenarios in your head, going over, you're overlaying on what you think other people are doing through introspection, right? And once again, you're just going over this head, boom, and out comes eventually a decision, a choice. Okay? So you form the scenarios of the future based upon various factors, forces that are likely to influence earnings growth, whatever it is, levels of uncertainty or other events relative to stock performance. Incorporates introspection to anticipate the probable assessments and actions of others. And progressing through the entire process, see the process, thymological process, like fundamental analysis process, right? The investor acquires what is needed to formulate an estimate of future performance. It's the thymological process that culminates into the action of buy, hold, or sell. All right? So this is a uniquely human process. And I think I know I'm running low on time, so let me just leave it with a quote by Mises. There's more, but what the heck, we'll just leave it here from the master. Quote, "For lack of any better tool, we must take recourse to thymology if we want to anticipate other people's future attitudes and actions. Out of our general thymological experience, acquired either directly from observing our fellow men and transacting business with them, or indirectly from reading and from hearsay, as well as out of our special experience acquired in previous contacts with the individuals or groups concerned, we try to form an opinion about their future conduct. It's easy to see in what the fundamental difference consists, at least for some, I guess, between this kind of anticipation and that of an engineer designing the plan for the construction of a bridge. Although, I'm a little leery about people being able to delineate those two things these days, but nevertheless, all right. I'll end it there, and so everybody has a chance to ask the other two panelists myself.